Welcome back, everyone, to the 5th edition of our quarterly uncredited video. Thanks for joining us today. In this edition, we will briefly talk about recent market concerns related to both the Fed and growth, and some color about earnings trends, as well as how all these factors may shape the fixed income investment landscape. I'll share 3 main points. First, the market is now more concerned that one of the fastest Fed rate hiking cycles and longer periods of peak Fed rates may finally lead to slower economic growth and earnings growth. Second, a weak June payroll and low inflation readings shifted investor focus from a long-standing concern about sticky inflation to the risk of slowing growth over the last few weeks. And finally, data since 1970 tells us that the Fed rate cut cycles support bonds no matter if it's a soft or hard landing, while stocks are probably going to be more reliant to deliver stronger returns if it's a soft landing. Now, in terms of earnings, it was a great second quarter season with estimated earnings growth around 11%, the highest in the fourth quarter of 2021, when you had 31%. However, estimated earnings per share growth in the third quarter have been slowing pretty substantially from around 8% most of this year to around 4.5% recently, possibly reflecting 2 factors: slowing manufacturing and falling oil prices since the second quarter of 2024. So now shifting gears a little bit, I'll ask Rafa, despite US companies not really talking too much about recession, there was mostly some comments related to manufacturing, industrial companies, as well as banks. In terms of your companies under your coverage, have you seen any sort of concerns about recession or either weaker guidance in general?
As you already mentioned, Alejandro, the earnings season was strong. Growth estimates were high, and overall companies were able to deliver above consensus results. Management was more cautious on guidance, but that's expected, given the higher start point moving forward. In developed markets, the communication sector was the one with most negative surprise. Because of that, spreads widened for the sector, and we believe that yields are attractive now, especially for higher quality companies under our coverage. We keep our overweight call in basic materials, giving premium to peers, even though a slower economic growth is a headwind for the sector. Emerging market companies in our coverage have also delivered good earnings, with most of the companies reducing net leverage in the quarter. The paper sector was highlighted, helped by the increase in pulp price. On the flip side, steel names were among the companies that increased leverage, still affected by Chinese exports.
Thanks, Rafael. Now I'll move to Marcelo. Have opportunities in the fixed income market shifted substantially since this new focus on slower growth?
As you mentioned, Alejandro, the latest economic data in the US points to a higher probability of rate cuts. As a result, we saw a meaningful repricing in US Treasuries in the past few weeks. The 10-year US Treasury is again below 4%. It is currently around 3.8%. In 2024, it was as high as 4.7% in April, and in October of last year, it was as high as 5%. The recent economic scare did not yet lead to an increase in default expectations, though. Corporate fundamentals remain solid, and spreads should remain well behaved while that continues to be the case. As a result, we see good investment opportunities in offshore credit. We continue to like investment-grade bonds in credit portfolios yielding between 4.5% and 5%. With a preference for the basic materials and communication sectors on names we follow, as Rafael said. Recently, we also upgraded emerging market bonds in our last investment committee. In this asset class, investors can get higher yields without necessarily running much higher credit risk when compared to US credit. Emerging markets bring an attractive combination of investment grade and high yield bonds. We recently discussed this in detail in a weekly Globe publication. Our article should be an interesting read for those who have not seen it yet. Our sector preference among emerging market names we follow continues to be basic materials and financials, with a more cautious view on consumer non-cyclicals. Finally, we are frequently asked about our duration views. While we think it's important to lock in higher yields, we believe it's important to do so carefully, particularly after the recent US Treasury rally. Most of our recommendations include bonds with maturities of up to 10 years in investment grade and up to 7 years in high yield. In summary, we think a scenario of Fed rate cuts and a slower but still resilient US economy should be positive for credit returns in the coming months.
Rafael, Marcelo, thanks very much for your insights. Thanks everyone for joining us today. If you have any questions, feel free to reach out to your banker or investor. We hope to see you next quarter with a new edition of On Credit.